Alright investors, welcome to today's stock breakdown. We're diving into FuboTV because recently it made a power play, teaming up with Disney, Hulu, plus Live TV, instantly becoming the second largest live TV streaming service in the US with a whopping of 6.2 million subscribers. Now let's remember that last year FuboTV filed an antitrust lawsuit against the Walt Disney Company, Fox Corporation, and Warner Bros. Including Discovery. Fubo was alleging that their planned sports streaming joint venture, Venue Sports, would monopolize the sports streaming market, stifle competition, and lead to higher prices for consumers, which at the time FuboTV argued that the defendants engaged in anti-competitive practices, such as forcing Fubo to carry non-sports channels as condition for licensing sports content and charging higher licensing fees compared to other distributors. These actions, according to Fubo, hinder its ability to offer competitive sports-focused streaming service. In August 2024, a federal judge granted Fubo a preliminary injunction which temporarily blocks the launch of Venue Sports. The court found that Fubo was likely to succeed in proving that the joint venture would substantially lessen competition and restrain trade. Let's remember that in early 2024, Fubo's TV stock experienced a significant decline because by March 1 of 2024, it had fallen to $1.90, marking a 57% decrease over that period. This downturn was definitely caused by the antitrust lawsuit against major media companies, which may have contributed to investors' uncertainty and the subsequent decline in the stock value. Now, a little fast forward, the lawsuit was settled in January 2025 when Disney announced plans to merge Hulu Plus Live TV with Fubo, acquiring a 70% stake in the combined entity. This merger essentially resolved the legal dispute and positioned the new venture as a significant player in the live TV streaming market. Right after the announcement, the stock rose almost $6 due to the momentum attributed to the factors such as strategic partnerships, content expansion, and the merger of Disney itself. Now, since that first spike, the stock has remained in the range of $3 to $4, which has caused many investors to ask if this is slam dunk or a trap in disguise. Let's break it down, starting with the positives. Before the merger, Fubo had 1.6 million subscribers, which is not bad, but nothing compared to YouTube's TV, 6 million plus. But now, after this purchase from Disney, Fubo has over 6.2 million subscribers overnight, and this is thanks to the partnership with Disney, which at the end of the day means if there's more subscribers, that essentially translate to ads and subscription, which is great for long-term growth. With Disney now owning 70% of Fubo, they have access to premium sports content such as ESPN, ABC, and Disney channels, which definitely make it way more attractive to sports lovers. If you love watching live games, this could be a game changer. The thing is now, Fubo isn't just streaming games, it's trying to bring sports betting into the experience, which give you the ability to place bets directly from your screen. That's where Fubo is heading, and if it works, it could be a huge source of extra revenue. Now, there's a couple of risks about this. The main one is that right now, Fubo still isn't profitable. Running a streaming service costs a ton of money, especially with all the sports licensing fees. And right now, Fubo is spending more than it's making. And yes, Disney, it is helping Fubo to grow fast, but since they own most of it, they also control its future. If Disney ever decides to take full control or shift focus elsewhere, Fubo could struggle to stay independent. And another concern is that the streaming industry is a tough game. There's a lot of competition such as YouTube TV, Sling TV, even Amazon, and all of them, they're competing for the same audience. If Fubo cannot keep up with reasonable prices and offer something unique, people might switch to other services. Now, it is important to note that in a worst case scenario that the deal doesn't go through, Disney must pay over $200 million on cash, which definitely will pay companies' debt. And at the end of the day, this could show us in the long term we can see an upside potential for all this stock. So if you are looking for a risky but potentially big reward stock, Fubo might be worth watching. The company has a huge growth potential, but it still has a lot to prove. For the short term, expect ups and downs as Fubo figures out its next move. And in the long term, if it gets its finances right and keeps growing, it could become a major player in the streaming world, which could elevate the stock not only to $10 but $20, and in a bullish scenario, even $50. So tell me in the comments section, you think Fubo is the next big streaming powerhouse or is just another underdog fighting to survive? Only time will tell. Definitely don't forget to like, comment, and subscribe for daily updates on the mark. Thank you very much and have a good day.